from the NASDAQ market site in New York City's Times Square, I'm Melissa Lee. Here's what fast is following tonight. Running with the bulls, the S&P 500 inching ever closer to a new record, and our traders are sharing their best ideas to trade the highs and still find value. Cracked foundation, are we setting up for another housing bubble? We've got a guest who says another drop in home prices is lurking in the shadows. And diamond in the rough, why this year's trash stock could be treasure for your portfolio. The analyst who's making a bold, bullish call on coal joins us with his take. But first, straight to our top story, and that is, of course, the S&P closing less than 2 points from an all-time high today. But how much steam is left in this rally? Tony Dwyer of Canaccord raising his forecast for the S&P 500 to 1760. That is a 13% rally from where we are right now, and it is the highest forecast on the street. So we ask our traders here, fact or fiction, will this rally take us to 1760 before the year is out? Pete Najarian, what do you say?
Well, you know that I tend to be bullish, but when I look at this kind of a number, I'm just not sure how we actually get there, because the financials have been the backbone of the rally. We've seen them participate already. We've seen the energy space participate. Obviously, you go defensive. You can see the pharmaceuticals. They hit another new high today in the XLV. So I'm not really sure how we're going to get to that level. I do remain bullish. I think we go to the upside. I think something north of 1600. But to get over that 1700 number, I just don't see enough in the cards for us to get to that level.
And we need technology, we need materials, and a lot of market technicians and strategists point to copper compared to the S&P 500 and how it has been diverging. The two have been diverging, which is not a good sign, Anthony.
Also, technically, we usually sell in May, and last May, if we remember, the markets dropped 5.5%. And so I would be very worried here in the near term, given the most recent run-up. So I'm going to say fiction.
What do you say, fast or fiction?
I just think for Tony's call to work out, look, you've got single-digit earnings growth. So the question is, how much room is there for multiple expansion? In other words, how much more positive will we get on whatever the earnings are going to be? And that's a tough thing seasonally, as Anthony points out right at this moment. Saying it's a little bit too early to say whether or not that's realistic. The linchpin of Tony's call is that systemic risk seems to have faded. But here's the thing about systemic risk. It rears its ugly head whenever it wants to, often without warning. So I think that's kind of a weak linchpin, if that's what it's based on.
In terms of the multiple that he's using to get to 17, it's 16 times S&P 500 operating earnings of $110 a share. Yeah, and he also says, by the way, that we could see a pullback down to 1,500, which could be a great entry point. I mean, imagine going from 1,500 to 1760. What a whipsaw of a move there, yeah.
Big moves.
Fast or fiction?
Fiction.
All right.
Fiction. For all the reasons these guys said, and for I'd add another reason. You know, as Josh just said, you know, it rears its ugly head when you least expect it, and I think that's what's going to happen. My view all along is we're going to get here. 2% yields in the 10-year, VIX down to 12. All those things have happened. We haven't seen the sell-off yet. Yesterday I said bookmark yesterday. Well, after today's action, throw away that bookmark. But if the market is doing a slow and steady grind until it doesn't, I think that's where we're headed. So I think 1760 is a bit of a pipe dream. We had Tony on the other day.
Yeah,
what did I say to him?
Last week
I said, Tony,
hey,
it sounds like you're really bullish.
Yeah.
You should raise your forecast. He said, blah, 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 blah. Now he doesn't.
Lo and behold, he's sandbagging you.
Yeah,
holding out.
Yeah.
You're holding out.
Well, one thing, though, to add, though, in Tony's favor, every single bull market since World War II has ended at least a 17 or 18 multiple. So there is a good likelihood we eventually get there. I'm just not sure if it happens in 2013.
All right, so fiction for now. Let's get to the top trades of the day meantime. Pete Najarian, what was your top trade?
Well, my top trade really stays in the energy space. We've been on this for a couple of weeks now. We've talked about refiners. They continue to go to new highs. Obviously today, a little bit less participation. But take a look at some of these pipeline plays as well. When you look at something like a One Oak, OKS, this is one of the names that hit up on our systems recently. We've been seeing time and time again the energy space hitting, whether it's the integrateds, the refiners, going into the service sector. We've seen just about every sector in that space moving to the upside. I touched on it at the top of the show, but energy's been one of those sectors that's been moving to the upside. I think some of those reasons make a lot of sense when you look at these pipeline plays. You're talking about huge dividend yields. You're talking about valuations that still seem reasonable at this point in the game. I think this is one of those names that actually got a lot more to the upside. We had some May 60 call buying just yesterday.
Yeah, Guy, you're going healthcare.
We've been healthcare for a while. We talked about Tenet Healthcare before they reverse split. A lot of people said there's no way they can survive post-split. We disagreed, and look at what that stock has done since. Up 2% today. The momentum's clearly behind it. The short interest says the stock's going to continue to go higher. Valuation may be getting a little rich, but as long as the short interest stays where it is, I think the stock continues to push north.
Anthony, your top trade today?
I like Philip Morris, and there's three quick reasons. 3.7% dividend yield, huge share repurchases coming. The only negative of this story is it's about a 17-18 multiple, so it's ahead of the market there slightly. But I think this stock has a ways to go through $100, and this is a classic large cap international growth story.
Is it also ahead of itself on a historical valuation metric?
Slightly, but because of where the dividend is, Melissa, that's why I like it so much. 3.7% dividend yield with share repurchase in this environment. We'll be long that and take it.
And Josh Brown, top trade.
Yeah, I like Pfizer. I've been very bullish. The healthcare sector today, another multi-year high, and this is a name that's actually gaining within that sector. I think $30 and higher is literally right around the corner. Stock acts great. I can't imagine any other pharma name I'd rather be in right now.
All right. Well, the S&P 500 may be less than 2 points away. I should say fewer than 2 points away from its record close. But our next guest is sounding the alarm on this rally. Allison Deans has more than 25 years experience in investment management and is a senior advisor at Varick Asset Management.
And Allison started at age 1, though. I just want to make sure the viewers... age 1. Go ahead, Allison. I had to say that for you.
Well, you say that there are some headwinds that could be facing us, and I feel like so many strategists out there come on and they say, well, there are headwinds. There's Europe, there's sequestration. But we haven't seen any of this, and the market keeps levitating.
I know, which really surprises me because I started my career around the 87 crash, and so many people were out of the market after the crash. The psychology was chase rallies. But I feel as if post-2000 and then 2008, everyone's gun shy and jumps out. But what I'm seeing is almost the same behavior I saw post-87, which is even bad news because it's incrementally not as bad as people thought. People are getting into the market. I think they're panicking in to some degree.
So when you say a pause, what kind of pause are you talking about? Like a 10% kind of pause or a pause?
I think 5 or 10% and maybe a lot of volatility throughout the spring and summer.
Right. The way you're positioned, though, and you're recommending small caps, tech, industrial, materials, regional banks, I mean, these are all sectors that scream when the markets are rallying, not necessarily when the markets are pausing.
Right.
So why would you recommend them now?
Well, my sense is if we're going to go through a choppy, volatile period, it's a time to start getting into the market and buying some of these names that are much more cyclical in their orientations. Because I feel as if economic growth is going to start to improve domestically, that if Washington behaves moderately better, and they seem to be, I think you're going to see corporate spending really start to pick up, which is very good for industrials, materials, as well as regional banks and small caps because they benefit from strong U.S. growth.
Allison, I'm not saying it's coming from you, but we've heard the pause argument now for a while. But is there going to be a signal that you think is out there that's going to tell us when this pause is happening, or is this something that starts to happen and it grows upon itself?
I think there'll be news that make people jittery. One, if Europe has another incident post the Cyprus, because for some reason for the past several years, right around April, May, Europe rears this ugly head and people become very worried. So some things seem to be getting worse about Europe. I also think we're still in a moderate growth economic environment, and while I think it's going to improve, that means a lot of the statistics will be a bit choppier and more volatile, and if we start seeing a string of not as strong statistics, I think that will make people nervous and start to pull out a bit.
And in your view, could the pause simply be seasonality, the seasonality that we traditionally see in the May timeframe in the market?
I think some of it's seasonal, although it's interesting because bad news seems to come out in the springtime as well. So there's seasonality that is on the bad news front as well.
All right, Allison, good to see you. Thanks for stopping by. Allison Deans of Varick. All right, let's get a market flash here from Josh Lipton, a name that's moving right now in the after-hour session. Josh.
Hey, Melissa. Well, Lionsgate and CBS teaming up, forming a joint venture to run the cable network TVGN and TVGuide.com. CBS saying it acquired the 50% stake in the cable network and website from One Equity Partners. That's the private equity arm of J.P. Morgan. Terms of the deal not disclosed. The report saying CBS was expected to pay some $100 million. CBS and Lionsgate will enter a 50-50 partnership for the channel and website. Melissa, back to you.
All right, Josh Lipton, thanks so much for that. If Lionsgate opened at these levels, this would be a record high for the stock, which, by the way, set a new one in today's session. Guy, you're a fan, even at these highs.
I think you have to be. I believe you have. Michael Burns has done everything right all along the way. Obviously, Mr. Icahn went against him 18 months or so ago. Michael proved to be right. Carl proved to be wrong. But I think that, again, this is one where the winds at their sails, they seem to be pushing all the right levers. I don't see any reason yet to get out of LGF.
All right, time now for pops and drops, big movers of the session. Got a popular for Tesla, up 1%. Josh Brown.
Yeah, Elon Musk yesterday tweeted out he's about to put his money where his mouth is, quote unquote, and make a major announcement. We still don't know exactly when that announcement will come, but they seem to want to bid this name up $40 is a pretty key level. That could be where a real breakout happens, but I would guess you have to wait for the actual announcement.
Top here for Seagate, up 3%. Geek.
Got a positive mention from one of the analysts today, along with Western Dig. I mean, these stocks tend to trade at low multiples, and they tend to move in violent fashions. You saw that today. But look over the last 6 months. We've had 5 to 8% moves over the course of a couple days in these names. We seem to be on the upswing, but be careful. If you have profits in this name over the next couple of days, you might want it to be taking profits.
Big drop for Molly Corp, down 5%. Pete.
You know, the revenues were down in the Q4. They were down actually 34% from Q3. And then when you look at the inventories are on the rise, the cash flows are on the decline. A lot of problems right now for Molly. There's a good reason why it's 52-week lows. I would expect to see it even actually go lower.
Got a drop here for Best Buy, down 2%. Anthony.
With Richard Schultz returning, I think people are selling because they don't think a deal is going to happen. But I think long-term this is good for the story. A little bit of a reinvigoration for management here. So look for opportunity here.
And we got a pop here for the Strawberryta.
Yeah.
1 year after the wildly successful launch of its Lime-A-Rita, Anheuser-Busch is now expanding its fruit salad of beer flavors to include strawberry. The malted berry brew made from a mix of Bud Light, lime, and strawberry flavoring hit shelves today. The Budweiser maker hopes sales of its new drink will be just as sweet as a lime version, which has become the industry's leading flavored malt beverage.
And Pete and I are going to get into a street fight, and we happen to be sitting next to each other.
On Strawberryta?
I'm sold to you.
You're a bear on the Strawberryta.
You like it.
Sucking down these
That's what I mean.
like a champion, my friend.
Lime-A-Rita's his middle name, buddy.
Yeah, baby.
Yeah. Coming up next, call it a dividend dilemma. What's the payout number that would put Apple
Don't name
in
any
a
kid
sweet
Lime-A-Rita, though, Pete. That's all.
Sweet spot with investors. The answer isn't as simple as you might think. We're taking a closer look at the numbers. We'll be back right after this break. And later on, housing data may be on the up and up, but there is one expert who is ready to throw cold water on this turnaround story. Stick around to find out why. Much more fast straight ahead.
His partner Jimmy Beam, and we drag along.
2/3 of our planet is covered by water. Yet 2/3 of the world's population will lack even clean water to drink in the near future. With a filter that removes impurities as tiny as 1/1,000,000th of a meter, Toray has designed a solution. Turn the seas into Earth's greatest freshwater resource. Green innovation made possible by Toray.
Each day, our planet awakens with signs of opportunity. But with opportunity comes risk. And to manage this risk, the world turns to CME Group. We help farmers lock in future prices. Banks manage interest rate changes. And airlines hedge fuel costs. All so they can manage their risks and move forward. It's simply a matter of following the signs. They all lead here. CME Group, how the world advances.
Welcome to a wonder that is Malaysia. Rich in beauty, culture and diversity. Only in Malaysia can you climb up one of the world's top 20 mountains and go deep into the sea in a matter of days.
Malaysia is an exotic land of diversity and culture. It is here that Asia truly comes alive. We have in place a strategic thrust to grow local and international tourism franchises that open up prospects for tourists and tourism partners alike. Above all, we are building a tourism infrastructure that celebrates the Malaysian warmth and hospitality, treating every visitor as guest in our own home with open arms and the best of care. Come and visit Malaysia, a land of sensory amazement and joy, a land that offers vibrant experiences and endless possibilities.
A brand new series.
As the new China leadership takes control, we meet the people and look at the issues that will shape China and influence the world.
On the debut episode.
Is President Xi Jinping the man to undertake difficult reforms? We go to the birthplace of modern reforms to find out. Will public rage over pollution clear the skies? And can the internet keep a check on corruption?
Join Eunice Yoon, Inside China. Friday at these times on CNBC.
Expectations are high that Apple will return more of its $137 billion cash hoard to shareholders by boosting its dividend. Shares are down 34% from its all-time high, so will a bigger dividend bring investors back? John Fort joins us now with more on Apple's dividend dilemma. John.
Yeah, Melissa, I talked to a couple of analysts today about their expectations. I have to say they're muted. I've seen some people saying analysts want a 50% hike, even a doubling of the current dividend. People I'm talking to are more in line with where Gene Munster over at Piper Jaffray came down today, around 32, 33%. The reason why is twofold, and that it's kind of what we talked about last week. For one, 2/3 of Apple's cash is overseas, and it'll get hit with a big tax if Apple tries to bring it back for dividends. But the other part is precedent. If they hike the dividend by 50% this year, people are going to expect another 50% hike next year, and you can always increase the dividend by more in the future, but if you slow down the rate of hikes, it looks bad. So what if Apple does boost it to $350 a share, say, or more than $13 billion per year? What kind of a yield is that? Well, over 3%. What our friend Colin Gillis at BCG says would be like a high-quality corporate bond. That yield would be in line with Cisco, HP, and Microsoft, but still less than Intel. Seems like the street would be satisfied with that. But would it be the kind of catalyst that would cause the stock to run like last year? Nobody I talked to thought so, guys.
I think the key here is that if you increase the dividend, it opens all of a sudden Apple to becoming a holding of a dividend fund, right? That needs to see the dividend increases in order to invest in a stock. And we've talked to a lot of dividend fund managers who say, yeah, we need that dividend increase. Otherwise, Apple cannot be on the radar screen, even though it's a value stock.
Yeah, and some of that makes sense. I mean, Karen Feinerman's talked about that for a long time. I know, Anthony, you've brought this up as well. But I think if they have to, if they really feel forced that their back's against the wall and they've got to put it somewhere, I think 3% makes a lot of sense. I don't like the company that you're looking at when you talk about, well, you just compared Cisco and Hewlett-Packard and Microsoft. A lot of companies that matured and suddenly they've got that 3% dividend yield and suddenly they're a company that's kind of basically gone nowhere at this stage.
Yeah, it's not a positive to be added to those dividend indexes. It hasn't worked for Intel, hasn't worked for any of the... Talk to an Intel shareholder, ask him how he likes his 3% dividend.
There is an internal debate going on at Apple. It's a very anti-Steve Jobs thing to do, because the return on invested capital is still higher than giving out a dividend. And so that's the big dilemma here. They're getting pushed by outside investors to do it, and I hope that Tim Cook stays true to the culture of Apple, keeps the company
Isn't that a isn't that a non-argument at this point? I mean, Apple today is a very different Apple than when Steve Jobs was there. It doesn't have that growth trajectory anymore. It doesn't have the margins. It doesn't have the revenue growth.
But at that inflection point, though, Melissa, if they go in that direction, they could end up in that Intel Cisco group, which I think they want to avoid.
John, yeah, go ahead.
I'm not so sure Apple is that different a company from when Steve Jobs was there. I mean, people these days act like it was all go, go, go the whole time he was there. But actually, between the iMac and the iPod, there were many years. Between the iPod and the iPhone, there were years and a stock dip. So it's not like they were just cranking on some mind-blowing product every single year. This could just be a natural lull in what they've got going on there.
The issue with Apple is not whether or not the dividend is 2 or 3%. That is not what's going to take this stock back to its prior trend.
You want growth.
No, you have to. So in 6 months, when the new line of products and new refreshes come out, that has a better shot at being a driver than whether or not the dividend is 2 or 3%. That is not what's going to bring growth investors back into the stock, bidding it higher, expanding the multiple. There's just no way.
All right, John, thank you for that report. John Fort This Week in Englewood Cliffs. Let's get a market flash. Josh Lipton on some of the pharmaceuticals names hitting new highs in today's session. Josh.
Yeah, hey there, Melissa. Well, a sector that our own Pete Najarian remains very bullish on, big pharma, which keeps rolling higher. An index of pharma stocks now at the highest level in more than 11 years. Notable gainers, Bristol Myers and Valiant, both up some 24% this year. Dow component Johnson & Johnson today hitting an all-time high. Melissa, back to you.
All right, thank you very much, Josh Lipton. Let's stick with healthcare here, and Josh Brown was taking a look at HCA Holdings today, new all-time highs. Give us the real-time trade today.
Yeah, before the open, we put a note out on HCA. It's a stock that we've been very positive on, pulled the trigger on a new buy rec. Essentially, the story here just continues to improve, and the outlook going out 2 years, 3 years, 4 years on the earnings front keeps getting better. This is basically an Affordable Health Care Act thesis whereby the biggest plague for all the hospital stocks is really all the bad debt expense, people who check in and can't pay for it. The company's on the hook. Under Obamacare, all of that is paid for. Politically, whether we like that or not is a different story. Look at it from the stock standpoint, they now have that yoke pulled off of their shoulders, and as a result, earnings estimates continue to be ratcheted up. HCA is unique in that it's very dominant in the South, the Southwest, and out West. especially the urban footprint, which is the largest in America. So it's really going to be the primary beneficiary of this new trend.
And it's not an overhang that about, 40% of its shares are owned by a private equity firm?
Yeah, and what you saw happen with the stock today, it had a huge day. $40 was a level that it had hit in February, backed off pretty substantially. Today it ripped above. There really is no resistance. There's no level at which people are down in this name. And so that acts as a tailwind once you get above there, which we did.
Well, to the point of both Josh and Josh, when I'm looking at these pharmaceutical names right now, you talked about earlier Pfizer. I do think that's an absolutely premier name in the space right now. When you look at the pipelines and you look at the moves that a lot of these drug companies had to make when they faced that whole patent cliff situation, they did an outstanding job of acquisitions. A lot of those acquisitions either in biotech or in the generic space, excuse me. But that's been absolutely something that you look at the pipelines now in the space, and they're in absolutely incredible shape right now.
The bottom line, just to put a punctuation on this thesis, the demographics are in your favor, not only in the U.S., Japan, and Europe, developed markets where people continue to age, but emerging markets are adopting more sophisticated health care every day. And once that starts, it ain't going back the other way. So I think that that's really what's underpinning the rally across the entire sector.
All right, coming up next, could one of the year's worst performers be poised to go from trash to treasure? We're talking to the analyst behind a bold call on Peabody Energy. And later on, we're down to just 16 stocks in our Fast Money Madness competition tonight. Our traders are fired up. They're ready to battle it out over 4 of the biggest names in technology. Stick with us to find out who will come out on top.
CNBC Meets in association with Bank of America Merrill Lynch.
She's still the most interesting person I know. I saw her in a class, and I, kind of sized her up for weeks before we ever talked. I said, this is going to be nothing but trouble because I can tell she is an extraordinary person, and I don't want to get involved with anybody right now. And then the famous encounter occurred in the law school library when she came up to me and she said, you're going to keep staring at me and I'm going to keep looking back. We should at least know our names. That's how we started. She's an amazing human being. It's all the world now knows, but very straightforward. I hope we helped each other through all these long years, but we sure have had a good time.
CNBC Meets in association with Bank of America Merrill Lynch.
Feel the power.
You hit it!
As music's biggest phenomenon is back on AXN. Adam, Blake, Shakira, and Usher. 15 Grammys, 26 #1 hits, 130 million albums sold, more than 1 billion fans.
Make me a winner.
The most powerful season yet.
Wow!
An all-new season of The Voice. Premieres at these times. First and exclusive on AXN.
The size of the Cypriot banking sector is so large that we found it justified to also involve the depositors.
This is not a very agreeable outcome for sure.
This would appear to put the Russian government on a collision course with Brussels.
You don't mess with the Russian mafia.
How long would the discussions last for, sir?
For as long as it takes.
Carlos Saris is going to walk away from Moscow empty-handed.
Will you do whatever it takes to keep Cyprus in the Eurozone?
Yes.
The fact of the matter is, this is ham-fisted from start to finish from the EU and the IMF.
We've managed to sign a bailout deal here in Brussels overnight.
The Russians were understandably disappointed.
This decision is painful for the Cypriot people.
Troika is doing fine. Actually, there are 2 of us, Look, we're doing okay. Thank you very much.
Welcome back to Fast Money. We're live at the NASDAQ market site in Times Square. Concern about the Obama administration and sequester fears keeping defense and aerospace stocks in limbo, but some stocks look ready to break out. Let's go off the charts and get Guy's take on some of these stocks poised to take off.
I believe so. Thank you, Mel. Thanks. Nice toss to me. I think the first thing we want to look at is Lockheed Martin. As you said, look at this stock. Look at its performance since the Obama administration came into power. Basically has moved sideways to slightly higher. Nowhere near as well as the overall tape. And I do believe that people are I think they're putting much too much emphasis on the sequester, defense cuts. I think these stocks are all poised. And I think people are going to be surprised by how powerful the rally you're going to see, and specifically Lockheed Martin.
So walk me through what you're seeing in this chart that makes you think that the stock's on the verge.
Well, look at the drop-off since the Obama administration came into power, and I think people look at defense spending and say, hey, it's going to get cut. We have Gandhi in office. That's not the case, folks. And I think the stocks, Lockheed Martin does not trade at a big multiple. I think the powerful rally you're going to see in the stock is ahead of it, and I think you're going to see it on the back of what has been a great tape, and I think it's going to be a catch-up rally in LMT specifically.
All right, COL, next up.
And by the way, it's a tremendous dividend you get in Lockheed Martin. Rockwell Collins, a little bit different. Obviously, this plays to basically the aerospace move. Pete's going to talk about Boeing after this, but Collins has been a stock.
You don't know what I'm talking about.
Well, I sort of do, but Collins has been a stock. I mean, Clayton does a great job as CEO. We've had on this show before. Valuation is fair. Dividend not nearly as good as Lockheed Martin, but again, a stock that's traded slightly higher to sideways over the last few years. Again, a name I think is going to break out. Both great companies. Both I think have been hurt because people think spending's not going to be there. I think it will be.
But you take a look at this chart, and let's talk about Boeing as well, because you take a look at this kind of chart, and it's trading sideways, and then finally it lifts along with the entire defense index, by the way, not just Rockwell Collins. And why do you think this is a better chart, better looking chart than Boeing shares, which have really done nicely?
I think Boeing's obviously, I mean, again, people speak to Boeing. Boeing's in a much different animal right now. I think a name like Collins will, and I generally don't do this, I think it will play catch-up. I think people throw Collins in the defense sector where they don't necessarily throw Boeing there. I think the move we've seen in Boeing over the last couple months, I think you're going to see it in Lockheed Martin and Rockwell Collins.
All right, Pete, where do you stand on Boeing now that it looks like the 787 fiasco is starting to lift?
Right, and I think Boeing does have still some upside, but I'd even look at a stock like ATK, Alliant Technology. This is another name in the aerospace it's defensive aerospace related, and when you take a look at what this is trading at single digits, $49 stock to 71. If you go back to where you were talking about, Guy, when you were talking about before the Obama administration actually even came into office, this is a $110 stock. So there's definitely, I think, some room to the upside still in front of this stock. I look at the entire defense space. I think you're right. I think there's a lot of promise in a lot of these different stocks going to the upside.
All right. Well, 2013 has been a rough year, to put it nicely. For Peabody Energy, the stock is down more than 21%, but it did get a boost today. Raymond James upgrading the stock to an outperform, raising its price target to $25 a share. Let's bring in the man behind the call, Jim Rawlinson, the Senior Vice President of Energy Research at Raymond James. Jim, great to have you with us.
Thank you. Glad to be here.
Not only on an absolute basis has the run year-to-date been abysmal, but also compared to its peers, it's one of the worst performing coal stocks in the group. Why do you think that there is a turnaround in place? Is it because of a broader call on coal prices at this point?
I'd love to make a broader call on coal prices at this point, given the performance over the last couple of years. I think it's more that things have stopped getting worse. And maybe on the margin started getting better. I think it's going to be a slow, steady, kind of gradual recovery that the sector sees, and hopefully, given the underperformance Peabody's had and trending back towards the lows of the last 12 months, we kind of thought the risk-reward started looking a little bit better if you're looking out 12 months, which is why we've got a 2 rating on it.
I'm just curious. I mean, this is you really have to search far and wide for a stock with a worse technical setup, understanding the fact that sometimes fundamentals turn before their share price. But wouldn't it be wise to actually get signs that things are turning around rather than trying to catch a bottom? Clearly the stock has no bottom, at least just yet. So on a valuation basis, valuation's tough as a catalyst. Wouldn't you prefer to see signs that the street is picking up on those changes at the margin? Or is it really worth catching that bottom tick if in fact you think you are right now?
Yeah, I think you're starting to see some signs of a bottom. I mean, if you look fundamentally, you look at natural gas, which took a big share out of coal markets last year. Prices are, meaningfully higher. In fact, last time this year, we were about $2 an MCF. You're almost twice that today. That starts to help turn around the demand side domestically for coal. On the met coal side of things, which is what's driven by the steel markets, you've seen a little bit of pickup. We just set the second quarter benchmark price up for the first time in several quarters, so that's no longer in free fall. And again, you've got a stock price that's kind of back to about where it was last July, and at that point in time, things were heading in a pretty bad direction. They've actually started heading in the right direction. It's just going to be a slow, steady ramp from here, I think.
So, Jim, part of this call, part of what is underpinning this call is a belief that nat gas prices will hold $3.50 to $4 and that utilities will actually start to switch. How long do we need to see this $3.50 to $4 hold in order for the utilities to say, you know what, we are going to make the switch? Because it's not as easy as flipping a switch.
Yeah, it's very price sensitive, and if you follow the data over the last several months, we saw obviously huge switching last year, and we've already seen, we only unfortunately have data through December thanks to our government, but the data so far has shown in November and December that started to come back when gas prices started to pick up, and from the data we can see, we think that continues into this year. Again, it's still on the margin, it's helpful, it's not, we're not going back to 07, 08 levels, but directionally things look a little bit better, and this stock was in the mid-20s, just a couple months ago with things looking not as good as they do today. And that's the simple call.
Jim, thanks for your time. Jim Rawlinson of Raymond James. Guy Adami.
Hi.
Would you step in here and buy BTU?
I've owned, Peabody's a name I've owned. I mean, this is a little bit playing stock market, which I respect, but it's an interesting call. The short answer is, the stock action, nothing has indicated to me that it's ready for a turn yet. It will at some point. It just hasn't happened yet, in my opinion.
You're a chart hater of this stock.
Oh, look at it.
Yeah.
You don't have to understand technical analysis to understand that every time it looks like a buyer shows up, 10 sellers come along. Here's the thing with this. It's an interesting spec just because of how horrible it's been.
Yeah.
So you can make a mean reversion argument, but below 1980, it looks like it goes right to 16. There's no support. So that would be where my stop would be placed, which doesn't give you a ton of breathing room on a long.
Yeah. All right, let's stick with commodities here. Bullion cannot catch a break these days. Gold down once again today on easing debt fears in Europe. And a large bet was wagered that the pain is just starting. Mike Coe, where are you? What did you see today?
Here I am in Chicago. Yeah, you know what we saw in GLD and the ETF for gold was the May 151 puts. Those were the most active options in GLD today. And if you were buying those things, they traded at an average price of about $1.30. You're making bearish bets that it's going to be below 149.70 by May expiration. And I think it's important to note that that actually is going to test lows in GLD that we haven't seen since May of last year.
All right, Mike Coe, thanks for that. Options action. If you are a believer in the housing recovery story, there may be reason